again. I'd like to welcome you guys back to another episode of WealthWiseGuru. I'm your host, John Schaff. I'd like to greet you guys at the top of the morning. And it is Monday, January 13th, 2025. And I'd like to welcome you all back to another episode of Wealth Wise Guru. A little bit waking up this morning a little bit late. Actually, I got up early and took a shower and lay back down and just not getting back up. And we are about 45 minutes after the bell has rung this morning. And so it's just not necessary to always get up at the opening of the bell. But then again, we are down this morning. 1,300 stocks are trading at, or the value of stocks in my portfolio this morning is at $64,179. And my aim and purpose is to get the rest of you up to this level, the ones that follow me. And the ones that are this level are either higher, congratulations. I hope that you will continue on your journey to building generational wealth. So let's look at the portfolio this morning. Looks like Tesla's down just a little bit. I have 202 holdings in my portfolio. And Tesla's trading at $4,655. I have 11.94 shares of it. Let's take a look at Tesla. So she's down this morning about a little over $5. And like I always say, when you see the market is down like this, just hang in there, and you only lose money on paper or on digital. As long as you do not sell out and get afraid because you think you're losing money in your portfolio, as long as you don't close out your position, then your portfolio can and it will come back, because we are in a bull market, and it has not been determined yet for this year whether it's going to be a bull market or either a bear market. And that won't be determined until after Trump inauguration, and probably around March, 2 months into after the new president take office. It'll be probably March when we know what the economy is going, and what his policies are doing for the economy as a whole. So until the end, it's, if you want to continue to make money, just put in yourself a put. And I have puts in my options. In my portfolio as well. And I have these puts so that I can continue to make a profit whichever way the market is moving. And so far now, today, we're having a market correction, or just pulling back. But like I said, the name of the game is to make money either way the market is moving. And so in the individual, I have Nvidia. I have a 575. I have a put in place, and that put is up $2.58. It has a market value of $593. I bought it at 110, and the expiration date is 117. Break even price is 132.35. Current price is 131.11. Total return for today is 285. And the total return period was 246. And like I said, this is a put I have in place. As you can see, the register is down $2.70. I have 108 shares of Nvidia and a market value over $14,270, and it's 23.80% of my portfolio. And so far today is down by $500. And this is just the regular equity of just buying and holding part of it is down by $500 some, but has a value of about $1,036. I have 7 options in Nvidia, and so far the return has been $127 and between 120. It was going back and forth, moving so fast, kind of hard to measure it. And this is just simply buying stocks and holding on to them. And like I always say, your time in the market beats trying to outdo the market. And a lot of times people try to outdo the market with different strategies. Time in the market means to continue to buy stocks in your portfolio and hold on to them over a period of time. Pioneer Technology is also a stock that I have in my portfolio. I have a put in Pioneer Technology as well. So Pioneer today is down by $3.01, and I have 151 shares of it, valued at $9,700. So far today is negative 400 something, and this is what I'm talking about. Over a period of time, you're buying these stocks and holding on to them. So when days like this happens, when times like this happens, you can withstand the correction of the market. The market is always going to have a correction, and so when you build up your portfolio, you can withstand it until the market rebounds. And then you want to continually to buy and purchase stocks, so that when the market does rebound, that would enhance your profit once you start to rebound. And most of my other options are a call. Still some of them are down in the red too this morning. And so none of them are going against me. So I just still watch them, see what's going on with it. This is a crypto. I only have one little thing, crypto. Like I said, I'm not a big crypto fan at all. You can't even tell me what you own when you're buying or either investing in crypto. You can't tell me what that is. If you have a farm and you are investing in that farm, if something was to go wrong with the investment part of that farm, you still own that. You still own that farm. But with crypto, something go wrong. You don't own nothing. It's nothing to own because it's not investing. It's speculation. And the market's not a place for speculation. And so when I see people investing in crypto, I see people that don't understand, know how to invest in the market. And it's pure, like I said, pure speculation. And pure speculation. And I don't do that. And we have quite a few other stocks that in our portfolio that's in the red this morning. So, like I said, you want to always buy in the red, and you want to take profit in the green. Class A Alphabet down to $2.54. I have 103 shares of it. Market value at $19,700. Total returns $259. Negative $259. Total return is $1,324. And so you definitely want to add and keep this in your portfolio as well. Amazon is at $2.17 today. It's down by $1.14. So like I said, you want to just start placing puts. If you're an option trader, just start placing puts in these companies, at least until March. So you go up and hit trade, and then you go up select the date, March 21st, 2025. And you put buy puts. If you have enough ownership in a company still buying, and you have to have at least 100 shares. Instead of buying, you can sell some puts, sell some shares. If you own 100 shares or more. But really, the idea is when you start selling shares, you have to at least own 100, if not 500 to 1,000 shares in your portfolio would be nice. 10,000 shares in your portfolio, and you hold on to those shares 5 and 10 years, and that one company that you or two companies that you own those shares in can actually make you $300,000 to $1 million, and that would be a nice retirement portfolio. But so if you didn't own shares, then you would want to just click on buy and puts. And puts mean that you're expecting for the value of the stock to decline. Let's see. And so I have a put in place here on Amazon. I've been watching, and it's for $3.21. Chance of profit is 33.97. Volume is 59, and volume means that's the current contracts that are in place on this particular put, and it has another 2,294 other individuals that are interested in this particular contract. Has a 33.55% volatility, and the delta is at that 41.33, which is not bad. And so we're gonna hit buy, and then you will hit 1, And then you would hit go ahead and put in the limiting price. You just put in 10.30. Make sure that stays high. This is what it's going to cost you to implement this particular strategy. $1,030. We go ahead and hit this. This is your loss column. And the only way you're going to lose this is if the market crash or something like that. The company just goes out, and you don't have to worry about that. From that black dot to that green area over here, this is your profit. And this is your potential payout or profit that you can gain, which is $20,470. I mean, it only costs you $1,030 to implement this particular strategy. And so since I don't have enough buying power, I would have to go to my bank and get $1,000 out of my bank in order to implement this particular strategy. And this is just for demonstration only. Just give you an idea of what you guys can make off of a put. And just think if you can make that off just buying a put. And buying a put is pure speculation, because you do not own 100 shares of that particular company. So you're buying a put, because you can't sell something if you don't own it. So just imagine if you own 100 shares of that put, and you wanted to sell it. And let's see, this is 217. Let's see, let's look at the 210 here. 210 has a volatility of 35, 39, 69.58% profit. See, the profit goes up 37% that you're going to be profitable with this particular strategy. Why? Because you own those shares that you're selling. When you buy a put, you're not owner. You're buying a position. It's different than buying a position and selling a position. You selling a position because you own that part of that position in order which you want to sell. And so you have 197 contracts in place, and then you have 5,484 other investors that are interested in this particular strategy. So this number here is going to go up, and so all that means that you have more of these contracts like this available in order to get in to where you can make a profit from each. The volatility is at 33.91%. Delta is at 35.09. That means 35.09, $35 is what you're going to be earning per day with this particular strategy. And theta is 0780. It's not a high theta. High theta means that the higher the theta is, the more it eats up at your profit. So you always want this to be a low number. These other numbers you don't have to worry about too tough. Then if you don't want to implement this, you can add it to the watch list. And then when it pops up on the screen, and then you can decide whether or not you want to invest in this particular strategy. So if we was to invest in, let's hit sell, and I know I do not have enough. I don't own enough of this stock in order to sell it. But I'm just going to show you guys when you try to do it, what happens. And see, here's the thing. Here's the thing about buying puts. If you own these stocks, so you go up here and you put a 1 there. And you go here and put this, just go and put 8. Okay, so that's not going to work. So let's put 7.90. You always want to make sure that number say high likelihood. Fine. Okay, here the estimated credit. When you're buying a put, the difference in buying a put and selling a put. When you buy a put, this is a debit. And when you sell a put, it's a credit. So when you sell a put and say you own at least 100 shares of a particular stock, see this price here? This is a credit. That credit is money. So this will automatically goes into your portfolio simply by you selling out of this position. And as long as the striking point of a particular strategy does not hit the striking point that you sold, not only do you get a chance to keep, this is what your premium, not only do you get a chance to keep this in your portfolio, you also get a chance to keep your shares. If the striking point hits and goes above what you set, then you still get a chance to keep your premium, but you actually lose your shares. And so that's the difference in buying a put and selling a put. And this is your break-even column here. And you can make a profit of $785. And like I say, the minute you implement this particular strategy, this $785 is going to go directly into your portfolio. And you can do this. You can do this on any company that you own in your portfolio. You can implement this particular strategy. Same thing with Tesla. You did the same thing with Tesla. You hit trade. You hit trade option. Then you go and select your date. This particular time, we're going to select March 21st simply because 2 months into President Trump being inaugurated, and his his policies and things should start to affect the market, and by then we should have a good idea whether or not we're going to have a bullish market or a bearish market. And so here's the current price. It's at $390.07 a share, or $389, going back and forth. So if you want to, again, if you have ownership of this particular company and you own 100 shares of it, and you want to maybe go down to see, the further you go down, the bigger the profit is. So if you went down, say to it's at 389. If you go down to like 370, and that would be a delta of 37.90 to a 38 now. Chance of profit with this particular strategy will be 65%, and it has a volume of 89, which means that you have currently 189 contracts in place. Open interest is 1,944. It means that they are interested in this contract as a whole. It has a really high volatility of 30.40 or 55%. And so you would hit this sale. You can add it to your watch list. But if you want to sell it, you just hit sale, and then you put the however many contracts you want, 1, 2, 3, 4, 5. And then you put in your limiting price over here. I would just this price over here is bid, and then you want to make sure to say highly likelihood. And once you implement this particular strategy, if you own at least 100 shares of this particular stock, then this will be your profit. This will be your premium or your credit. So this will come available to you right away in your portfolio. And if the striking point on March 21st does not hit the striking point that you set, then not only do you get a chance, not only do you keep your profit in your portfolio, but you also keep the shares that you own. If it does hit, then you keep this, but you lose your shares. And so that's the difference in selling a put and buying a put. Of course, it's always better to sell because you don't have ownership of it. But if you do not have sale, you click buy a put because you're knowing what you're doing. Instead of selling shares, you're buying a strategy. And so I would go out to, let's look at 375, and it has a delta of 37, 39, a theta of 26.77. Chance of profit is going down 30% because you don't own this. You're buying into a position. Chance of profit here is 34.45%, and the volume of 202. Open interest 1944, and has a high volatile interest, high volatility of 60.63. And you can add it to your watch list, or you can just buy this position as well. If you hit buy, again, you put the 1 there, and then you put the 340 there. And then instead of this being a credit going into your portfolio, this is actually going to be a debit. So this is actually the price that you're going to have to pay in order to implement this particular strategy. And then so you go down here and hit this area, and this is more breakdown of your of this particular strategy. The only way you lose this if the market was to crash, or this company did something to cause it to crash or something. But this is your profit area here on the black to the green. And this is your potential profit on this particular strategy, which is $34,475. So hopefully you guys have learned something in these different strategies, and whether you're buying or selling a put. Hopefully you guys have learned something from this video. I'm John Schaff, your host, and you are viewing another episode of WealthWise Guru. And like I always say, I am not an expert. I'm just a guy that trades in real life terms in the stock market. I'm not an accountant. And I bring you my trades in real life time. And I use the YouTube platforms in order to show you these particular trades that I'm doing. You follow me, you should have the same profit as I am. And so hopefully, if you do get into one of these trades, and your trades, like say this one goes against you, you can just simply hit trade and hit roll position. And like any movement that you do in the market, you're gonna have to pay in order to make another move. Sometimes it can be beneficial to you, then sometimes it may not. This particular trade here, I still have 4 more days on it. This is a 1 cent credit. I have been in this position before where I have had 1 cent credit, and I changed and select roll into another position. You just select new position. You can keep the same date. You can just simply roll out and just change another date. I'll do that again. just select a new date. Wait till that disappear. Oh, it take a long time for that disappear. Okay. I don't know why that's stuck up now. Seems crazy. But so you roll and select a new date. And you could see the current date select for this is January 17th. So you just go up in the top here and just select your new date. And you can go 30 days out. You can go a week out. You can go 2 weeks out. You can go 30 days out. You can go 90 days out. We can go out, say September 19th. Current position is 231. It's going to be a call. And a call means that you're expecting for this particular strategy to go up. So by September, what would you expect for? I think this is Apple. Yeah, what would you expect for their current price to be? So let's look at 245. If we go to 245, the chance of profit is 29.23%. It has a volume of 75, and then open interest of over 4,000. Volatility is only 23%. That's a delta of 48. What delta's is a decent delta. And so you'll click roll. And the higher the delta when you're doing a call, the more profit that you should have in this particular strategy. And so if I was to roll this particular position, total debt is $1,514, and it'd be changed to 245 days. So I mean 245 days will be adding to this particular strategy. And so you'll hit continuation, and then you go up top here. Then you put in 1, and here I put in 15.20. And so it's going to be hard to get a high probability of this being accepted. But this is just demonstration only. If you have a stop like this, options, and it started to go against you. So this was actually cost me $1,520 to implement this strategy, just to roll out of the current position, or out of a bad position into a good position. Or you can just in turn just let it die out, and if it die out, when it reaches maturity date, it'll just expire worthless. And so I think that's going to do it for today's video. I don't want to hold you guys too long, and be mindful of your time. Again, this is WealthWiseGuru. May all your trades be a good one and a successful one. And if nothing else significantly happens the rest of the day that affects the market in some kind of way or another, then I will see you guys again Tuesday morning at the opening of the bell. Until then, hopefully you have a good day. Be safe, be blessed, and we'll see you on Tuesday morning at the opening of the bell. And again, we thank you for watching.
Oh, yo. Oh. Wait, what?